Markets seem like they've come to a grinding halt. Hello, ladies and gentlemen, and welcome back. Today we discuss this chart and what it means for markets moving forward through the next couple of weeks into the next few months. For 2 months, 4 months, and even 10 months now, we've traded in a kangaroo-style market. Up, down, and all around, all the time coming back to the most traded zone. So what does this mean moving forward as we enter into a period of complacency with the Federal Reserve, Silicon Valley Bank, Credit Suisse, and a bunch of financial crises going on around us? As many people think, it's all just fine, but what's going on underneath the hood might surprise you. Let's take a look right now. Well, welcome back everybody to the Daily Show. Today we're talking about the latest and hottest stocks, commodities, and cryptos, including the charts, macro, and news data. If it's your first time here, why not consider subscribing and smash that like button? We've got some amazing data points coming your way to do with what's happened in the past and what's happening right now. Some great similarities there. So we'll start with the story of Silicon Valley Bank. 142 billion in 2 days was the extent of the bank run. And what it tells us is that markets are so quick to make these huge reactionary moves because of the modern day and age, the internet, etc. And what it means also is that central bankers don't really have 2 weeks to deliberate on questions. So what they tend to do is over pump the system, which is something we've seen recently. It's why we're seeing tech stocks still holding so high. The pump is in for growth assets. Let's talk about range-bound markets though, because we've come back to the equilibrium point of the last 2 months, 4 months, and 10 months. Now, luckily we have data points from this over history, and we can actually have a look at those and see what tends to happen. The bad news for investors could be that we're going into another 3 months at least of kangaroo-style markets. So that means up, down, and all around has to be the normal expectation. So you've got to follow channels like this one so that you're aware of the big changes that are occurring, because it's expected when we trade so much at equilibrium, which we'll look at later on, that we basically continue to stay in these kangaroo-style markets, up, down, potentially 10, 15, even %. Now, in context, what was happening in some of these other previous data points? Well, in the 40s, we actually had FOMC policy of tightening due to high inflation. Interesting period. We also have a lot of pauses that went on around these periods, and again, mostly tightening cycles. So really interesting to see similarities there between previous periods of kangaroo market and the current kangaroo market we're in. I also shared this chart over on our Twitter. Follow the links in the description down below if you're interested, at FX Evolution. And it really shows you, again, how fast central bankers have to move. So this is the surge of emergency borrowing credits allowed. And you can see that 2023 is not like others. It's bigger than the global financial crisis. It's bigger than 2020 in terms of the pandemic and shutting down the economies. And it just shows you the extent of where the financial system is being pushed. Now, each time is not the same. Obviously, over here, we have poor lending standards. If it turns out we have incredibly poor lending standards here, well, we need to be concerned. But I would prefer to remain optimistic on markets over the longer term here until most likely poor lending standards resurface, most likely sometime later on this decade. And I think we'll talk about that in future videos. So what about some data points to do with what's going on right here, right now? Well, it turns out here, Carson's information, which is really good, has come out with, well, it turns out that if we hold December lows, which we didn't in 2021, but if we hold the December lows in the first quarter of the year, then we tend to actually be pretty optimistic. In fact, 94.4% of the times of these massive amounts of reads, we tend to go into fairly bullish markets. And the average return is really nice. Like we're talking 18.1% or 18.6 on the average. So percentage time 94.4 will show on the charts later on that it's unlikely that we will take out the December low. Now, it's only one data point, but certainly something that I'm looking at on the charts. Let's talk about insiders now. Insiders keep purchasing, and it turns out they're purchasing staples. In fact, insiders are purchasing staples, and they've just kind of turned on the purchasing in the last couple of weeks. Now, we've seen this in the defensive nature of the markets, which, as we know, it's kind of like a rotation box, and markets are rotating through all these different sectors all the time. They've turned on from kind of like the lagging to the improving in defensives over the last 2 weeks. Realistically, since March 8th, in fact, we've seen that flow. Again, go check out our Twitter. We posted that and put it in the video in the previous video. We're also seeing insiders starting to buy financials. Now, I'm not suggesting financials is a great purchase. Obviously, the green line here shows us that people are selling it. Insiders are buying. They have very different time frames, and you've seen them buy before, pretty heavily through this block here of accumulation, and they've purchased at decent standards, even up here in the highs. So it's not like they always get it right, but what I would say is they're starting to look at it from a long-term perspective, and that's a big difference to the short term, which could be more pain as regulation comes through. We know the markets are run by the Fed at the moment. This is just a chart to show you how bad this tapering job is doing. They keep claiming they're tapering, yet in literally a week and a half, they took off half of all of the taper that they put on during 2022. I mean, it's almost a disgrace, isn't it? Now, whenever you see the Fed's balance sheet go up, in general, growth assets tend to do very well, and that's why your tech stocks are flying at the moment. Also, lower interest rates does help as well. This is an up-to-date chart in terms of what's going on realistically in the back end. Here is the injection. There's a few extra things I look at in this, and I can tell you we're basically trading there as of today. I'll keep updating it if any big changes happen, but following the Fed balance sheet will be so important moving forward. Here's another chart to do with the Fed probabilities in the meeting moving forward of whether we're going to get a 25 basis point hike or not. This will be data dependent. I expect, and I think you need to be on top of this, the jobs numbers that are coming out first week of March, first week of April are going to be so important. Will we actually see unemployment start to spike up? We've got the likes of Disney and others actually firing people, and this is going to flow through. And remember, when we see unemployment generally spike up, it means 3 to 6 months away on average with bond yield inversion, which we have right now, which means that the short date and the long dates are all inverted, that we're going to see a US recession. Now, of course, the Fed's not going to say that. None of the people in the Fed are ever going to talk about recession, but these numbers are showing you that the economists have absolutely no idea what's going on. Little wonder why the market's trading at neutrality. When the Fed pivots, of course, this is the famous one that everyone's talking about right now, markets tend to break and they tend to go bad. I think you need to keep this in your mind. Even with kangaroo style markets, worse things can happen. Now, I'm probably more expecting these types of periods, maybe 2015, 16, and maybe over here in the 1970s, 80s. I don't think it's one of these, but you never know. Compression of earnings could be another big thing. And we know that markets at the moment, which are trading right here, 4K, so we're trading right in that middle zone, are currently not pricing in a recession. If you look at our previous video again, the bonds market's freaking out, and the stock market's like, it's all good, nothing to see here. And I feel like that's just a direct result of the Fed. And the market's getting complacent, saying the Federal Reserve will do whatever it takes to protect the stock market. I'm not so sure that's true. And I think one of the things that we have a debate about is how long will they actually pause and pivot. We know they're pivoting. I'll show you why and why the bonds market's most likely on that. But in the past history, they've tended to hold the rate for a period of time, then cut. Markets at the moment are pricing in instant cuts. That's a very different story. And I think the markets might crack it at the Fed if they don't get what they want. And we know the Fed is slow to enact. Remember that whole transitory inflation thing and how long it took them to respond to that? Well, imagine about the pivot thing. It's going to be pretty wild. Smart money versus dumb money chart, always interesting to look at. So we're seeing basically smart money inflows, showing some signs of just stabilization, probably selling a little bit into dumb money now that they've bought the markets back up, especially in the Qs, which is where they were most active, obviously NASDAQ style stocks. I can tell you that in the back end, managed money as of pretty much February has been selling, or January actually has been selling the market net in terms of they've been reducing their overall purchases. So they were purchasing at a pretty high standard throughout December, October, all the way through. And then now they've started reducing. So that really shows you again that they're neutral in this market. They don't have too many opinions. Hedges, as in leveraged hedges, are starting to short the market a little bit hotter. We'll have that in the next video, so definitely stay tuned for that. EPS, we've talked about it a million times. If this is turned negative, usually means bad things for earnings coming up. And it also usually lines into this chart, which is from Morgan Stanley's Mike Wilson, which talks about ERP, which is basically risk coming back into stocks. And at the moment, we are down in here. Like we are literally almost no risk being taken into consideration. It is fully fledged complacency in this market. So can we see the big players doing anything underneath? Let's have a look at the last 24 hours of trade. We can see technology started to sell off a little bit. So we did certainly get a little bit of sell off in tech, which probably comes from some profit taking from people at these highs. And then we saw some staples and defensives come through. Now, if we take the last 5 days, you might notice the leaders, mostly staple style businesses. So that XLP, XLU are two of the top three, which basically means the markets are turning a mixture of defensive. And of course, over the last 10, 15 days, they've been buying up pretty much specifically just technology stocks, thanks to the Fed balance sheet and interest rates going down. Now, as we're stabilizing and seeing tapering coming through from the Fed, well, they claim tapering. We saw a little bit of tapering on certain market actions. Then the markets are going, well, maybe that's the high for now. Let's go back down. And we'll just kangaroo around for the rest of the period. And that's why we need to be nimble and fast in these markets at this stage. Now, a lot of people make a big deal about volume dropping off. Look, it's certainly down. You can see here the volume going through the markets at the moment, very high through that turbulent time, but it's pretty much just returned back to its normalized volume. So it's pretty normal volume going through. You can see as I scroll down through here that 4 is not unusual in these markets. Let's move over now to pretty much Exhibit A, which is going to be why we know the Fed is about to pivot. Now, I know it's not new news, but I think it's good to have on your chart. US 2-year versus the federal funds rate. The federal funds rate is the yellow line. And the thing I'm only really want to bring up here is, well, firstly, we know that if the 2-year goes underneath the funds rate, that historically has meant a pivot's coming and the market sniffed it out. And I think we all know that's occurring. What I wanted to point out, though, was how long they tend to hold the rate before placing the cuts. And I think this is where the market will disconnect from the Fed and they'll crack it. Basically, the market will crack it at the Fed for not moving quickly enough. So over here, we have a pivot that lasts from basically July 06 all the way to June 07. Probably too long. The market would absolutely go mental if that occurred. 1st of Jan 2019 to July 2019, we sit on the same rate, 6 months. Now, if you bring up a US 3-month, you'll notice the rate is at 4.77. So already the market is basically pricing in a bunch of rate cuts. So they're saying, hey, we're going to get rate cuts from the Fed. Well, is that true? Remember, inflation has never been beaten until core CPI comes underneath year on year, underneath the federal funds rate. So I think the Fed know this, and I don't suggest for any moment that they won't push QE basically back into the system to support the financial stability of the markets. But at the same time, they will most likely hold rates for as long as they need to stop inflation. Now, I don't know, again, if you agree with me on this, but this is the way I'm looking at it at this stage. And if we go through, December of 2022, they're expecting so many rate cuts by the end of this year that we're at 4.1. I just don't know if the Fed doesn't tend to do that. The Fed is slow and they look, again, transitory inflation. How long did it take them to do things? So I expect the market to be probably wrong here, and then maybe that to be a catalyst to push the markets down as we see maybe worse earnings coming forward and, more importantly, bad future projections. I can tell you in the private credit market, things have dried up a bit over the last 2 to 3 weeks. I mean, little wonder why that may have happened. Suddenly businesses that don't earn money aren't being looked at that favorably. Here's a chart that you should always have on your screens. It's junk bonds. Obviously, if junk bonds fall through our magical level down here, we need to be paying attention. We'll delete the S&P from this chart just so you can see it. And that's the 72.58. So I'm looking for junk bonds underneath that. If markets have not gone to new lows or not moved down, then that's usually a pretty good warning sign, kind of like the canary in the coal mine, that bad things are about to occur. What about treasuries? Well, treasuries have been pretty disappointing, you'd have to say. I mean, considering where the US 10-year is, treasuries realistically are being sold off by a bunch of, I would say, large entities. And that's telling us a little bit about the markets. I'm not really concerned about treasuries like a lot of other people are, but I think that would be a bit ridiculous, really. But long term, I expect treasuries still to increase. They are not usually a trade. They are more of an investment philosophy. Supercritical zone remains at 10958, and it's unlikely that you'll be able to get through that until the US 10-year actually gets underneath 3.32. So again, treasury is probably going to be a slow grind for a little while until the market decides it's really sick. Let's have a look now at the US dollar. So in the previous video, we talked about the US dollar coming down to a critical zone, and we'll look here on the 2-hour. Now, it actually hit that zone, and we're seeing a switch. So we went underneath this demand, and I kind of suspected that might occur, and we might go into this 61.8 fib pullback, and also previous resistance becomes support and stuff. This should be where buyers for the dollar come back in. So yeah, it's a little bit sneaky what it did through here, but I think this is the more likely kind of rally here for the US dollar. There's a giant gap sitting from the Monday trade. I wouldn't be surprised at all if we do something like that for now, as we see yields stabilize and the market realize that maybe the Fed will not move as quickly as the market expects them to, because remember, they're a bit sloth-like. So yeah, this one up here, 10283, I find that a pretty egregious gap. And I certainly think we've come to a demand zone for dollar. So I'd like to see dollar spike here. Even though the trend's been down, I would like to see it spike. Gold keeps coming back to that. Look at that, 1974. Didn't quite get to 1976, which is pretty much the most traded zone throughout this range. So yeah, gold likes being in here. We've got extremes on the highs and lows. So $2,000 an ounce seems to be sellers there. 1937, kind of, that's where, you expect those buyers. And the most traded zone is 76. So we're at a fair value for gold. We saw huge amounts of call increases coming through on gold. If you join our Discord in the economics room, there's a little tab there that showed it. But basically, yeah, gold is in stabilization. I don't know whether it's accumulation or distribution yet. I'm obviously bullish gold long term, but at this stage, I'm totally neutral on it while we look at it sitting in those ranges. Be nimble and fast, be reactive, more of a scalp day trade concept. And we're at fair value right now, so hard to see what it's doing. Copper remains at our intersection point that we've pointed out now for days and days and days. It will be interesting if copper falls off, usually not good for the stock market. Let's have a look at the Widowmaker natural gas. It's coming down. I'd like to see it go underneath 2.09. So at this stage, natural gas has not done that. Probably needs to take out some stops down here. This is a nasty, nasty pair. So we saw that initial bounce here, correct? Then we came down, and I've pretty much suspected we're going to clean that low. You've got to be careful on this one. It's not really a trade. It's more of a multi-month philosophy again, and it has huge rolls. And look, it's called the Widowmaker for a reason. It moves big. So I'm looking to see whether it can make a new low, and we can start like a Wyckoff style accumulation bottom. We'll see. We'll keep following that story. Oil continues to be hovering around a pretty critical zone for bears to resurface and try to short it off. It's going to be very susceptible to yields. You see yields rise, I would expect, oil to go back up into those 77 a barrel. This is an obvious zone for shorters to come back in, which means it really needs a lot of kind of work to actually get down. If we look at the action that we've now seen and we go to something like a 15-minute chart, you pretty much need oil underneath here. So that's 72,187. I'm looking for it to kind of do something like that. At this stage, I'm not really bearish on it until we see a switch of turn. And we just haven't seen that just yet. So we'll keep watching. And of course, we know it's at a critical level. Tesla remains kind of bearish. We still haven't filled that gap. So here's the gap from the previous close. Some people will say, well, we filled it here. Well, technically the close was here and then the open was here. So we haven't really filled it. We've come back down to some fair, but we've still got that open. I like to see it come all the way back in. So Tesla will be in line with the market, but this is such a critical zone. If you're a bull of Tesla and it gets through 200, well, you can have a little smiley face if it closed above there. I think that's very good for you. It did get upgraded, remember, to I think 265 by one of the big houses, and it couldn't even hold. That's a bit weird. Usually when you get upgrades, they hold up. So look, Tesla's still grinding lower. It's going to come in line with the market, and we'll see what our thoughts are very soon on that. Apple continues to kind of struggle around this zone. Obviously, it came off this level, which would have been a good little intraday buy. Previous resistances, previous close levels, obviously this level of demand. I think for Apple to really turn towards the negative side, it's going to need to go underneath 154.24. And at the moment, we're mostly in bullish trend. So once we take that out, we've got a change of trend towards the downside. Again, the cues, that's going to show us the way. Nvidia, something similar, still in an upward trend, still consolidating. No new information here about it yet. We'll keep reporting on it. XLY, XLP, this is the American consumer showing us that we've got defensive action still going on in the markets. Markets are going defensive while holding this zone. It's not really a bullish signal generally, especially when the markets are at highs on the cues. The DAX, still boring, sitting at underneath 15,280. We haven't seen a breakout bullish. We haven't seen a breakout bearish yet. We'll keep reporting on it. Same with the Australian market. It's holding our base zone here. Certainly a very interesting level, a decent level for some people in the Australian market. If we take a low though, get ready for 67 or even a 64. So if we take a low underneath here, I think bad things will happen. The US market and copper will dictate that one there. IWM, Russell 2000, very interesting chart. Need to keep paying attention to this one. I'm using the US 2000, and you can make a lot of cases for this being the low. Obviously, a huge amount of wicks, so that's case one. Huge amounts of stealing of stop losses underneath this 1700 level. And if we breach past 1800 and we don't immediately sell back off, this is probably a Wyckoff style bottom. So we do have a lot going on for it. It's trading at basically equilibrium or a fair price in the middle here. I could see it going bearish here or even bullish. Unfortunately, that makes it very tough to trade, but it's a great chart, and I would set alerts underneath 1700 to see how the market reacts to that point. Let's move over to the Qs. Now, they didn't have a great session. They actually came down a little bit. Here's the monthly. So only a few days away till this closes. It's going to be a big deal. Weekly, obviously putting in some good work last week on the weekly. Daily, so daily is shaky. Is this an accumulation that was like a stop loss hunt and now we just ballistically run through? If we close above this white line up here, I feel like the Nasdaq's going to keep going up. You see, I don't really have too many opinions on the market movement here. I could see a case for it to go up thanks to the Fed and the balance sheet, and I could also see a case for it to come down. And that's unfortunately with trading, sometimes you're very, very, very clear. Sometimes it's a little bit tough because complacency is real and earnings is only just around the corner. Remember, we start off with the banks only a few weeks away. So you've got to be very nimble and fast in this market right now. And historically, April's been amazing for markets. So, no, maybe not last year, but it historically has been amazing for markets. So again, you can make those cases. We haven't got enough strong signals here from the Nasdaq. If you take a look at the futures, now that's where things change a little bit. It kind of looks negative. So the market overall has been making a series of lower peaks or lower highs. It's now broken through this say trend line here. It's coming back into a bit of a supply and the futures market action, which obviously is going bullish at this stage. So could it be that this is actually where the turn happens towards the short? Well, the Nasdaq still looks more short than long at this current level, okay, at this current level. The SPY is just boring looking and ridiculous. The SPX like almost forms a 2-day long leg doji. You can see here the high and the low. So it's clearly happy with where it's at. Why wouldn't it be happy? 4K is like the most traded zone of the last 10 months. So it's been sitting there for ages. And then the US 500 did some things that were a little bit interesting over the last 24 hours. They broke past this 39.67. Now, I suspected that would rally, which it has done. It went down a little bit more than I'd like, though. I would have liked it just to break and then rally. It's come back to this critical area. And if bears are going to rejoice and get hold of this series of lower highs again, they kind of need to short it here and push it back down. Now, initially I thought, oh, we're going to hold 39.45 and hold this trend line and stuff. But with the nature of the market and how it's reacted now, and it's come down to a kind of bizarro level here, then found instant buyers. I feel like if we do make a new low, it's unlikely this trend line most people see now will hold. And we're more likely than not to go underneath that and maybe push into 38.60s. So that's probably the bear case right now. If you're a bull though, you just want this thing daily close above 4,010 most likely. Get above that, move into critical 40-80, 40-70 zones. So we've got some critical levels up here in the 40-80, 40-70s. All these zones up here would be open. And I do feel like that's probably, where we're at. We're in equilibrium. We know the markets are at fair value. We know they're neutral. We're waiting for a catalyst to push it in either direction. Currently, it's more bearish than bullish because of the small price action. But, again, if it does something else and it closed above certain levels, it's probably going bullish for a period of time. We'll move over to Bitcoin. That actually looks all right. I mean, it's holding this level. My goodness, it just holds it. This white line we put in the other day continues to hold it up. Nice little kind of rejection here, double wicks coming off the bottom base, which is really important. We need, if you're a Bitcoin bull, you need Bitcoin to hold up, and we're still looking for that 30,200 kind of level for now. Will we get it? Well, the trend's still up, so we'll keep going with that. Let's move over to the news for the week ahead. Is there anything important? We've got some information, so let's just quickly scroll back here. It's not insane. Basically, we've got Thursday unemployment claims and final GDP numbers. And then on the Friday, we have the core PCE price index. But I do think that we go through to the next week, then we start to get some big data. ISM, manufacturing PMI, and we scroll down and we start to get the jobs numbers. So the jobs numbers, non-farm payrolls, Thursday, April the 6th. I think that's going to be a pretty big event in terms of finding out where we're at in this supposed recession recycling kind of period. Are we actually seeing unemployment rise? If you have enjoyed today's video, why not consider subscribing, smashing that like button, and following us also through the other social media platforms we have. You can do so by clicking the link tree description down below and also grabbing some 3 free trading cheat sheets if you're interested. Thanks so much for watching, guys, and I hope you have a great day. Very interesting markets ahead. We're just waiting for a proper breakout. Stay tuned.